Microfinance represents one of the most powerful tools for creating positive social change through investment. It's a system that provides financial services to people who have been traditionally excluded from the banking sector, helping them build businesses and improve their lives. Today, let's explore how small loans can create transformative impact in developing economies. Microfinance is the provision of financial services to low-income individuals and small businesses in developing economies who lack access to traditional banking. These are people who cannot walk into a regular bank and get a loan because they don't have collateral, credit history, or minimum balance requirements. Microfinance fills this critical gap by offering banking services tailored to their unique circumstances. The scale of financial exclusion is staggering. Approximately 1.7 billion adults worldwide lack access to basic bank accounts. Of these unbanked individuals, 70% live in developing economies across Africa, Asia, and Latin America. Without access to formal financial services, these individuals cannot save securely, obtain credit to start businesses, or invest in their future. This creates a cycle of poverty that's difficult to break. The microfinance model is straightforward and effective. First, small loans are issued to entrepreneurs who have viable business ideas but no access to traditional credit. Second, these borrowers use the capital to start or expand their businesses, whether it's buying inventory, equipment, or raw materials. Third, as their businesses generate income, borrowers earn money to support their families and repay their loans. Finally, loans are repaid with modest interest, and the capital is recycled to help more entrepreneurs. Microfinance loans are quite different from traditional bank loans. The loan amounts are small, typically ranging from $50 to $500, which may seem modest, but is often life-changing in developing economies. Interest rates range from 15 to 35% annually, which covers operational costs and default risks while remaining more affordable than informal moneylenders. Repayment periods usually span 6 to 24 months with regular installments. Remarkably, repayment rates are exceptionally high, between 95 and 98%, demonstrating the reliability and commitment of borrowers. The social impact of microfinance extends far beyond financial returns. It creates jobs and stimulates economic growth in communities that desperately need it. Microfinance helps reduce poverty for entire families, as business income supports education, healthcare, and nutrition. Women's empowerment is a particularly significant outcome, as approximately 80% of microfinance borrowers are women who gain economic independence and decision-making power. Finally, successful businesses strengthen entire communities through increased local commerce and improved living standards. Let's consider Maria's story to understand microfinance in practice. Maria is a talented seamstress living in a rural Kenyan village. She receives a $200 microloan to purchase a sewing machine. With this equipment, she can take on more clients and produce higher quality garments. Her business grows successfully, and she employs 3 other women from her community. Over 18 months, Maria repays her loan while continuing to expand her business. Her success creates a ripple effect, improving lives beyond just her own family. If you're interested in supporting microfinance, there are several investment options available. You can invest directly in microfinance institutions, which are organizations that provide loans and services on the ground. Alternatively, microfinance funds offer diversified portfolios across multiple institutions and countries, reducing individual risk. Finally, peer-to-peer lending platforms connect individual investors directly with specific entrepreneurs, allowing you to choose exactly who you want to support and follow their progress. Like any investment, microfinance carries certain risks that must be understood. Currency risk arises because loans are made in local currencies that may fluctuate against your home currency. Political risk includes potential regulatory changes or instability in the countries where microfinance operates. Default risk exists when borrowers cannot repay their loans due to business failure or unforeseen circumstances. Liquidity risk means your capital may be tied up for extended periods with limited options to exit early. Understanding these risks helps you make informed investment decisions. Let's recap the essential points about microfinance. It provides crucial financial access to populations that traditional banks don't serve, breaking cycles of poverty and exclusion. Small loans, often just a few $100s, can create significant social and economic impact that transforms lives and communities. The high repayment rates, typically above 95%, demonstrate that microfinance is not charity, but a sustainable, effective system. Investment options range from institutional funds to direct peer-to-peer lending, allowing you to choose the approach that matches your goals. Microfinance proves that doing good and smart investing can go hand in hand.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.